Hello, my name is Kim Santos and I am the Director of the Office of Credit Unions. I really wish I could be meeting with you in person. I will do my best to provide you with an update on regulatory issues. I want to start by thanking everyone for their efforts during the pandemic. Who would have thought that a year and a half later we'd still be dealing with it? All credit unions have done a great job of adjusting their operations to serve their members. You have been creative and very resilient. Things won't be the same as they were, and nobody knows what the future holds, but I know we will learn from this and be stronger than ever. I will start by giving an update on the mid-year data. As of June 30th, the overall financial picture is very strong. There were 117 credit unions and assets rose to over $53 billion. Net worth continues to drop but is still strong with ratio over 10%. We have been watching the drop in net worth across all peer groups. Boards and management also need to be aware of capital levels to ensure they remain adequate for the risk profile of the credit union. The delinquent loan-to-loan ratio continues to decline and is at an historically low level. Management has done a really good job with maintaining asset quality both before and during the pandemic. The provision for loan loss expense was only $7 million as compared to a year ago when it was $82 million. It is understandable that credit unions funded their allowance for loan loss account as the pandemic took hold and are now adjusting the account based on current information as well as an improved economy. Credit unions have also been adjusting their operating expenses and their cost of funds, so net income is much higher than it was 1 year ago. Loan growth is up, which is a positive sign, but share growth continues to be elevated, so the loan-to-share ratio dropped again and is just under 80%, which is the lowest it has been for many years. There continues to be a lot of liquidity within the system. One thing that is noticeable when looking at the data is the growing performance disparity between the large and small to mid-sized credit unions. There are 17 credit unions with assets over $500 million. These 17 credit unions comprise 44 of the $53 billion in assets, and they drive the overall financial numbers and trends. We see the disparity in the earnings and the growth ratios. Fortunately, the smaller peer groups tend to have higher capital levels. The economic conditions have improved this year, and the outlook is good. However, I still think there are many unknowns, and credit union performance will be affected by continued fallout from the pandemic. Also, some relief efforts will be ending, which could lead to higher delinquency and charge-offs. The Office of Credit Unions will continue to monitor credit union performance. We will work with credit unions to ensure that they remain viable. The mid-year bulletin is posted on the DFI website for your review. Regarding mergers, the number has been low for the past few years. There were 4 mergers in 2018, 4 in 2019, and 3 last year. This year through June, there was only 1 merger. However, there will be at least 4 other mergers prior to the end of the year. I do expect that mergers may increase due to the financial struggles and many other issues facing credit unions. I will now transition to provide an update on regulatory issues. This year, the Office of Credit Unions published 2 letters to credit unions. The first provides an update to changes to various administrative rules. These took effect on July 1. 4 rules were repealed and minor changes were made to other rules. The letter documents all of the changes. The second letter provides guidance when credit unions use impermissible investments to offset their employee benefit costs. As you know, there is no statute or rule regarding this. In addition, we have recently seen a lot more activity in this area due to an increase in the liquidity. We also have begun to take a much more thorough look at these investments, both when reviewing applications and at exams. Our examiners have spent a lot of time and effort to learn and understand products credit unions are investing in, such as credit union-owned life insurance, collateral assignment split dollar plans, and managed investment accounts. The guidance is broken down into sections. I want to draw your attention to the general factors section. Management and boards need to focus on the areas within this section, such as having a policy, a legal review of contracts, the identification and assessment of risks, setting reasonable limits, and an ongoing review of this area. In addition to these 2 letters, we are in the process of updating a 2014 letter on derivatives authority. NCUA recently updated their rule for federal credit unions and are in the process of updating related guidance. As soon as we get that, we will be updating our letter and guidance, and that will be posted on the website. If you have any questions about any of the letters, please call our office. In regards to our member business loan rule, we are still waiting from a response from the NCUA regarding our request to update the definition of a business loan. Both Brett Thompson and I have been attempting to get a response. I think we are both hopeful that one will be coming soon, and we will be sure to update all credit unions as soon as we get any update. NCUA has been very busy this year with their guidance. This year they have issued 8 letters to credit unions, 8 regulatory alerts, as well as a supervisory letter. I encourage you to frequent their website for these letters and other resources. I would like to point out just a few items. First, right now, the transition to new exam software called Merit is a big focus of our office. NCUA recently issued a letter to credit unions about their modernization efforts, which includes Merit. I encourage you all to review this letter for details and information about outreach. Next, a few other activities that NCUA has been working on. First, there is a new rule on the capitalization of interest in connection with loan workouts and loan modifications. A letter to credit unions was published on this in early August. Second, CECL will be effective in January of 2023. NCUA just passed a rule that will allow credit unions to phase in the adverse effects on regulatory capital that may result from the adoption of CECL. More will be coming out on this. Next, LIBOR is being discontinued. NCUA has issued a letter to credit unions and a supervisory letter on the transition. The FFIC also issued a joint statement on managing the LIBOR transition. And finally, NCUA is seeking comments on a proposed rule that would provide a simplified measure of capital adequacy for complex credit unions. and these are credit unions with assets of over $500 million. In the proposed rule, a complex credit union that maintains a minimum net worth ratio and meets other criteria will be eligible to opt into the credit union leverage ratio framework. This proposed rule is open for comments until the middle of October. Again, please reference the NCUA website for much more information. In preparing these comments, it makes me reflect on the status of credit unions and the industry. As a regulator, I want all credit unions to grow, thrive, and succeed. Unfortunately, some do not and will end up merging. I now want to identify some of the challenges that I see. These are not new. You deal with them each day. Cybersecurity and technology-driven changes are here to stay and are not going away. The pandemic made this clear. This area is always a regulatory focus, and examiners will be recommending that you update your disaster recovery plan in light of the pandemic. Succession planning is crucial. Lately, I have been notified of several CEO retirements. Thankfully, these credit unions will continue with new management. However, all boards must engage in succession planning, and there are many resources out there to assist. Increased competition is a challenge. I am noting that it is more difficult to get new members and loans. Credit unions will have to be creative and think outside of the box. We will also work with credit unions on new products and services. In addition, we will work with credit unions to expand their field of membership if that is an avenue that you are considering. From an examiner perspective, the areas of interest rate risk, liquidity, and overall asset liability management need to be strong to assess and mitigate your risks. The financial trends of lower net worth, shrinking margins, and fewer loans need to be monitored in conjunction with your ALM and your strategic planning. I know that regulation is a burden. We are in an industry that is highly regulated, and certain statutes, rules, and regulations must be followed. However, our examiners will do their best to work with credit unions based on their size, their complexity, and their risk. There are many issues out there that you deal with. Some examples are strategic planning as well as board governance issues, staffing and employee challenges resulting from this pandemic. Climate change is an emerging risk. Virtual currencies and digital assets is also up and coming, and there are many more. However, it is not all gloom and doom. Where there is a challenge, there is an opportunity. While we do have mergers, credit unions do continue to grow and thrive. I went back to the financial data from when I was a new examiner. At that time, there were many more credit unions, but total assets were just under $5 billion. Today, we have several credit unions that are over or approaching $5 billion in assets. And that is not to say that bigger is always better. We need credit unions of all sizes. Credit unions serve members all over the state. Many serve the underserved, and many serve communities that are underserved. Credit unions are very good at helping each other out, and when they do that, they help us out. Credit unions are not shy about taking advantage of their opportunities to make themselves and the industry stronger. In closing, I want to thank you all for all that you do. The credit union industry in our wonderful state is very active, strong, and one of the best in the nation. I encourage you to tell your stories. I and others at the Office of Credit Unions are always available if you have questions, suggestions, or concerns. please reach out. I wish you the best and look forward to seeing you in person soon. Thank you.